Private credit is under stress. Rising redemptions, fears of loan defaults, and talk of a SaaS-pocalypse has led to a debate over its rapid growth. Is private credit the next crisis or the next opportunity for everyday investors? Blackstone has been at the forefront of the private credit revolution, and Joan Solotar is global head of Blackstone Private Wealth. Thank you so much for joining us. Great to be here at Blackstone. So we know Blackstone is this giant private equity firm. Tell us a bit about what you do and what your specific business is.
Well, first, thanks for having me. Love talking about my business. So I run the global private wealth business, which today stands at over $300 billion across the many asset classes that Blackstone invests in. And that's out of over $1.3 trillion at the firm level. And what we do is provide institutional quality solutions to individuals around the world.
And to be clear, you're not selling directly to clients. You're mostly selling to the firms that then sell to the clients. So tell us a bit more about that business model.
Exactly. So our clients are the financial advisors who interact with individuals at all different levels. And it's about providing not just product, but also education, marketing, investor support, home office support. So we really run it as an end-to-end business, matching the good performance of Blackstone with the gold standard service of our team.
And you've been running this business for 15 years. Blackstone's really been at the forefront of this whole revolution of bringing alternatives and private assets and private capital to more and more investors. Tell us about where we are in that process.
So we are still super early. I like to say we are not even in the first inning. I think we're still in spring training because when you think about how pension funds are allocated, about a third of their investments are in privates, or the top foundations and endowments, similar levels. The same with family offices, and then you move over to individuals. We're still under 5% if you look in investor portfolios. And then if you go to retirement accounts, hopefully we'll get to that too, you're less than 1%, close to zero. Wow. So I just see this as a very long-term path of travel with the same trends happening globally, and it is super early.
And the question is why? Why should, yes, we've seen the larger investors in this space for a long time. Yeah. Why should smaller investors also be in this space?
I really think it's the same reason. Investors want cash in their pocket in the form of yield, or they want to be able to generate appreciation over a long period of time and benefit from that powerful compounding effect. So same as institutions. And why does it make sense for individuals not to have that same access? And it's not just about higher yield or higher returns. It's also about what these funds and investments can do in a portfolio in terms of bringing down volatility or provided very welcome diversification to what they already have. And so to me, it's, well, I would say in the past, it was only the wealthiest individuals who had access, and why should that be?
And the big institutions.
And the big institutions.
Yeah. And the numbers, when I look at the Blackstone growth, are just staggering. I couldn't even believe them. Maybe you can confirm if they're true. But I think in 2017, the assets under management in this particular group were something like $58 billion. Now it's, what, 300? Is that correct? 300 billion?
It is, yes. And I would say when, so back at that time, we had an investor day. I had put out this number that I thought we could grow to $250 billion over 10 years. And when I put that number out, because we were then the biggest at 58 and no one else was really out there, there was a ton of skepticism.
Really?
Yes, but I will tell you, for some reason, that was less believable than today when we say we want to get to $1 trillion. Everyone thinks like, oh, that's an easy thing to do now.
And $1 trillion by when?
I don't have a specific time horizon, but
more like 10 than 20 years, probably?
Yes, I would say for sure. When I look out at what the opportunity set is, whether it's the massive defined contribution market or expanding in major countries. Japan has the second largest private wealth asset base with over half of their investments still in cash, but increasingly open to private investments. Or Canada, Australia. There are so many major markets where we're just at the very, very beginnings. We see huge opportunity there. And then it's mostly in the US, which is still the biggest market, the widening from the highest net worth qualified purchasers, people who have 5 million or above, to the accredited investor, 1 to 5, and then to the mass wealth. And that is what we're seeing. So the wider you make that funnel, the more people who are coming in. And these are now cycle tested over a period of time. There is more education out there. I think these will just become ubiquitous in well-constructed portfolios.
And you mentioned they're cycle tested. We're seeing a lot of headlines now, concerns about private credit, and a lot of redemptions, and a lot of noise about that. What do you make of all of it?
So I think there's an element of it that's a natural cycle, and then there's an element of it that's responding to headlines. And so I think you have to always step back and try to separate the signal from the noise, and that's what we try to do. So there are real questions to ask. Are we going to see higher losses? Is there an issue with the structure of the funds? Do people understand what they own and the like? In my view, you've had all these calls that the house is on fire, when what we see is maybe a piece of burnt toast, meaning you had portfolios that were new. In a new portfolio, you generally don't have losses. Losses get to a more normalized level as the portfolio seasons. We're also in the midst of an economy that's quite resilient in the US. We do not see escalating losses. So I just step back, take a pause, and say, okay, let's put out there what some of the worst case scenarios could be. And I think the worst published downside case that we see out there, someone put out a 15% loss case. So let's take that. And let's assume that happens over 3 years. And we have a portfolio that's already marked at 97%, with the bottom 10% of our portfolio marked at around 80%. So let's just use the 97. And again, take that over 3 years. The math basically suggests that you'll have a loss of total return of about 300 basis points per year. It's just not a disaster. And when we talk about cycle testing... So just to put that in perspective,
if a private credit fund is delivering 9 or 10%, that means in your worst case scenario, that return goes to 6 or 7%.
From the losses.
From the losses.
And then what are other things that could happen? Those would be widening of credit spreads, which could happen. We saw that going back in 2023.
And
that
we're seeing credit
returns
spreads widening now.
Yeah. So could you have a scenario where for some period these funds are returning single digit that's like, I don't know, 3 to 5%? And is that a disaster? And what's happening in the public equivalents? Because when I look in the public equivalents, so they're actually down.
Yeah.
So we're still outperforming, and that's the key. Why are institutions still allocating? Because they're looking at the spread to the publics and think over the cycle they can outperform by 200 to 300 basis points. That's the same for individuals. And so I think it's a matter of staying calm, understanding what you own, what the real downside is. You'll have some natural rotation, I think, from credit to other asset classes. But the reason the funds are designed with caps is so that, unlike the public funds, your flows will not force you into realizing losses at an inopportune time.
Right.
And so I think that's the other important piece. When we look over cycles at how the publics perform versus the privates are at a major advantage because they didn't sell into the weakness. And I think you, at the end of the day, want to protect investor performance. That's what we want to do.
Right.
And I believe that's what we'll be able to do.
Well, but there's this, and that points to this curious mismatch of liquidity where initially people said, well, you're giving illiquid products to more everyday investors, more retail investors that shouldn't have these illiquid products. And so the idea was these products are a risk to these investors. In fact, what's turned out to be the case is the investors are the risk to the products because now they're the ones pulling all the money out. Is there a risk to the private credit industry and the alts industry to have too many investors that don't really understand the products and panic at a moment's notice?
So I'll just use our real estate experience as a great analogy and bridge. So we are the biggest real estate investors in the world. We have an open-ended fund. We were going into a real estate cycle, negative cycle, interest rates going through the roof, and redemptions were coming in. And we capped, so it took longer for people to get back their money. The experience that they had through that period, I think, was quite good. We've been able to outperform both peers and the publics by a very wide margin.
Some tough headlines, though, in between.
Tough headlines. We don't write the headlines. I wish we did. I wish we did. And so, again, I think it's separating the signal from the noise. And what is reality? So we have a lot of tough headlines. I think there's a lot of commentators from the industry, not from the private credit industry, but others on the outside. And I always question, what their motivation is and coming in, very, very negatively when just the facts on the ground don't support it. But I don't think that investors are a risk for the structures, but you have to manage the structure properly. So what does that mean? How are you thinking about liquidity in your fund? And how are you thinking about the quality of what's in your portfolio? So what we found in real estate is we owned very high quality real estate. We marked it appropriately. And so when we went to sell things off in the market, we were able to do it overall at or above the mark. And I think the same will be true in credit. The cycle will show differences, one manager versus another.
Yeah.
Who invested well, who had better underwriting standards, and importantly in credit, who's actually able to get stronger recoveries. So, I think about our firm, all of the tools that we have on the private equity side. If we do have to take the keys over, we know how to actually manage companies well. So I think all of that goes into investor outcomes. So I worry less about investors not understanding. Those aren't the questions we're getting, I will tell you, and they weren't the questions we got in real estate. We did not hear, we didn't understand the structure. We didn't know there were caps. The questions are really about the performance of the fund and people trying to get answers to, what happens on the downside. Now, in that scenario, the vast majority of investors stayed with the fund, right? And so far to date, in most of the private credit funds, that's been the case as well. I can't predict the future, but I don't think these are going away.
When you look at the redemptions, and I'm sure you've had some clients or some people come to you and say, well, we're nervous about the potential of this, we want to redeem. What is your response to this large wave of redemptions that we're seeing in clients that might want to say, you know what, you say trust you say the portfolio looks like, but I don't want to have to worry about it, just take my money out?
I think that's okay. I'm okay with it. I think if you're nervous and you feel like you want to take your money out, I think that's perfectly fine. The conversations that we're having often from folks who are doing that is they want to know where they should be putting their money in. So most people don't want to take it out and leave it in cash.
Yeah.
And I think that's the benefit of having the full breadth of a platform. First of all, no one on my team is a commissioned salesperson. So we're not just like, you have to own, our credit fund. We really are indifferent. We're just speaking to the value of private investments. But if you want to talk about inflation and protection with infrastructure, or tax efficiency with real estate, or the most bang for the buck growth in private equity, we're happy to do that too. So I'm really indifferent as to where the money moves. I think there's real value to having a diversified portfolio, but I think that's okay.
On the regulatory front, we're seeing a lot of a change in view in Washington, where there's a view toward step by step bringing more private market capital and products into 401ks. Lloyd Blankfein, the former CEO of Goldman Sachs, recently said it's, quote, crazy to bring these products, particularly private credit, into 401ks, because if these people get burned, then there are a lot of voters who then call for regulatory change. Do you see any risk that if there are some blow-ups, and they might be minor, in some firms, that this regulatory path toward opening up more access that we're seeing now could be reversed?
I think it's a great question, and I think everyone has to be very well educated on what they're putting in the portfolios, how the structures work, the limits of liquidity, how they interact with other parts of the portfolio, and the like. But I guess I would ask Lloyd if he has private investments in his portfolio, and I'm guessing the answer is yes. I'm just guessing. So
well,
to
he would say for a rich guy like himself, it's fine. But when it's everyday mom and pop saving for retirement, and they can't get their money out when they need it, and they lose return when they need it, that's different from a Lloyd Blankfein.
Of course. First of all, you have risk in public markets, and over time, public markets are more volatile than private markets, number one. But number two, what would match the long time horizon of private investing more than retirement investing? And how often is it that an individual is asking to have all of their retirement money pulled out in a single day? So these will be part of big pools of capital. I would not expect that anyone would put all of their retirement savings into private investing. But 10, 20%. Does that make sense for most individuals? It probably does. And I think, again, when you look at how pension funds have constructed for retirement, and there are differences, as we know, those are pooled assets, and so I know there are nuances, but their outcomes have been better. And that's just what we're trying to deliver. But these need to be fully thought through. But to me, it's not a trend, it's not a marketing point, it's just about investor and retiree outcomes.
Yeah.
And I believe these can improve those outcomes.
And do you think some of the panic is just driven by a lack of transparency? I mean, you know, the Journal recently did a piece where they said that the stated number or exposure to software by certain funds was actually half of what it was because people were segmenting them in a different category. No one believes the marks for a lot of these funds. You know, is there something to be said for the argument that, look, because we can't see what's actually happening, we're not going to trust it?
It is the perfect question. So first I would say the categorizations didn't come about when market concerns emerged around software, right? The categorizations happened when deals were originated, which is when everyone wanted exposure to software and tech.
Right.
So it's a little ironic. If anything, it would be the reverse, that folks were trying to inflate. But typically, everyone's just following a methodology that's either based on Git codes or whatever it is. So I don't believe there was game playing broadly, certainly not in our portfolio. But the transparency question I love, because the word private only relates to the fact that these aren't publicly traded, but there is nothing private.
Doesn't
You
mean
can
secret.
see, it doesn't mean secret or shadowy. In fact, I was a financial institutions analyst for many years, and I will tell you, the banks do not let you know how they're carrying any of their loans. You can see big categories, risk categories. We actually show you at the single individual loan level. There is so much transparency, and we report that every single quarter. And the marks are not made up. Aside from the auditors, who would have no incentive to inflate marks, we have third parties then coming in. But I always think the proof is in the pudding, right? Like, we've been running these funds, private funds, for over 40 years. Where are you selling? Doesn't matter the asset category, whether it's a company or a property or a loan, relative to how you were carrying it. And it's quite unusual to sell below the mark, which suggests that these are appropriate marks. Now, that doesn't mean they don't change over time as circumstances change. And so if there's a change in a quarter, you're going to see a mark go down. I think that's what you should expect. But I actually think the transparency is quite significant, certainly relative to the public's and what's out there where you have no idea.
Joan, thanks so much for your time
Thank
today.
you.
We really appreciate it.